Good day. Today is Sunday, September 22nd, and I apologize if you were looking for my podcast last week. I took the weekend off, so this will cover the last 2 weeks. This podcast, and like every week, we're going to cover the economy, the market, and then regulation. And our focus, of course, will be on the banking industry. My name is Cjlqa. I am the president of CJL Quantum Analytics LLC, a bank investment advisory firm, and where we do investment research with a focus on banking. I spent 26 years in the banking industry as a regulator, as a bank officer at community bank, and then also as a consultant. So let's start out with the economy. Well, I guess the big news is that the Fed dropped their target rate 50 basis points. So this should have an impact on the yield curve and on the economy. But it's anticipated that further cuts will occur in the remainder of this year and then also next year. So we did see an adjustment to the yield curve. It's more inverted now. It's more a normal yield curve than it was before. We still don't have It's still not a new normal yield curve, but it's not inverted like it was before. So, and it was inverted for about 2 years. So the thing to remember is interest rates drop, valuations will increase, stock valuations will increase. However, there's some give and take. So, like for banks, for example, they do better financially when rates rise because they're able to charge more on their loans, on their assets. When rates drop, then it affects their ability to charge interest on their loans. That's one thing that would affect a bank conversely. In general, rates drop, that increases valuations on stock. Now, with a bank, again, if rates go down, that affects their earnings. But also another factor that affects earnings is if the economy, if we fall into a recession, or if delinquencies start to rise, like they have been for credit cards and automobile loans, then this has a bearing also on earnings and would negatively affect banks. So in short, the economy, we're starting to see a slight drop in rates. This is affecting the yield curve. There's also anticipation that because rates will be lower in America, then the demand for the U.S. dollar is going to decline. So this will affect our economy in the sense of trading with other foreign countries or foreign companies. So it's something to look at in the future. Yield curve, we saw the 2 years at 3.57, 10-year at 3.72 or 3, and 30 years at 4.1 roughly percent. These are the yields on the yield curve. So you can see that's upward sloping. So we're getting closer to a normal yield curve. It's just that the shorter rates are actually still higher than the 2 year. So uh, like the target rate's 4.5 to 5 or 4.75 to 5. So that's higher than the 2 year. And that target rate is the overnight rate. That's the Fed funds target rate. The unemployment rate, um, there's pressure on it to increase. We saw numbers in new jobs and that type of thing are slowing down. So there's definitely the economy is slowing down, and there's fewer jobs available are being created. We are looking at doing a soft landing. So the Fed's trying to measure its rate cuts in light of that, because that's our target. We want to have a soft landing. We don't want to have a severe recession. Nobody wants that. So we want to have a soft landing and catapult that into a expansionary phase of the business cycle. So looking at the market, an interesting note is that financial services is one of the leaders for the year. So if you look at year to date, the last week, last month, last 3 months, and in the last year, the financial services is one of the leading sectors in the economy. For the year, it's at 36.9% increase or growth. So that's good news if you're a bank investor. Just to make a note of it, our national debt is at $35.3 trillion. And I believe for this year, fiscal year, which ends September 30th, which is a fast approaching here in a week or two, that's at $1.87 trillion deficit right now. So we're over the budget, almost $2 trillion for the year, and I think that's being debated in the halls of Congress right now between the Republicans and Democrats, and they come up with a spending bill to cover our shortfall. Something of interest is that in this year, 2024, there was only two de novo banks that were created. And so the question is, why is that when in the past we've had hundreds of de novo banks created in the past every year? And personally, I think it has something to do with the the obstacles you have to overcome to enter the industry as a new bank. It's all the regulations. The fact that if you're a national bank, then there's certain capital requirements. If you're state chartered bank, then there's capital requirements. A lot of times the state might be trying to limit being pressured by other bankers trying to limit the entry point for other banks. And so it's something to consider. One of the easiest things, the way to make money in banking is, and that's why you don't have to be a genius to be a banker, a community banker. That is because you're just managing assets over the cost of funds. So it doesn't seem that complicated to manage a yield on your assets over your funding costs. And so one observation that I've made is that banks that start out and say you started investing in bonds and you manage the spread and the duration between your assets and liabilities, um, they tend to do better financially. We're looking at returns on assets of 2.5%, and the return on equity could be 10 times that very easily. And then if you leverage it, it could even be more. Something to think about. And then traditionally banks are lenders. If you talk to a bank and the president's a lender, they think the way to make money is making loans. Okay. But if you talk to the CFO and your financial managers, they say, well, the way to make money, let's do bonds. It's another form of lending. It's a bond, and you purchase the bond, and you're lending money to the bond issuer, and it takes the overhead's lower because it takes fewer people to manage those type of assets than it does lending. Lending is very labor intensive. I mean, let's say you have a construction loan portfolio. I mean, you got to do inspections, things like that, and it's labor intensive. Okay, so let's talk about the markets. So, of course, the day after the rates dropped, there was a 50 basis point drop by the Fed in the overnight rate. Of course, the market responded the next day. And we had a big jump. I mean, it was a big day to make money that day. Well, then people started thinking about it. Things reverse course, and so they kind of settled back in a little bit. So, if we're looking at the sectors again, if I look at for the past year, the financial services sector is one of the highest producing sectors in our economy at almost 37% return. If I'm looking at where it is today, I see that gold is up, consumer staples, utilities, and telecommunications. So what's interesting is that when you look at the macro level of the market, you see people are shifting their funds. So the money managers, investment managers, sophisticated investors are shifting their money to utilities and consumer staples. That's happening on a massive scale. Okay, so it might be time to start readjusting your portfolios. Those defensive stocks and consumer staples, that's part of the business cycle that is there's a slowdown in the economic growth, but also during a recession. So those sectors tend to do better statistically than others in that part of the business cycle. Okay, so something to think about when you're managing your portfolio. Okay, so that's the sector. Quick look at the defensive stocks, and what I see in here is that most of them are up. Defensive stocks like Clorox, Campbell Soups, energy or utilities, some science and engineering companies, consumer products, grocery. Again, we're looking at consumer staples, groceries, Eli Lilly, pharmaceutical, or healthcare. Again, we're those type of companies, consumer staples, Procter and Gamble, they're up, and they should be because people are moving their money into that part of the sector. Okay, cyclical stocks. Again, we would expect to see consumer staples and utilities doing better. All right, now I'm shifting over to the money center banks, and there's six of them in our country: Bank of America, Citigroup, Goldman Sachs, J.P. Morgan Chase, Morgan Stanley, and Wells Fargo Corporation. Um, half of them are up, half of them are down. So there's a mixed bag there for our money center banks. And remember that a money center bank is more diversified than a community bank because it not only has the asset liability management, where you're managing the spread and duration on your assets and liabilities and those sides of your ledger, but also you're making fees. Like you've got fees for services, but you also have fees like investment banking fees. Okay, so let's look at diversified banks. And most of those, I'd say about two-thirds of them are down. This includes ancillary companies that service the banking industry. For example, ICE, International Intercontinental Exchange. Okay, so really no definitive pattern. I go to the just focus on the banking industry and not ancillary companies, but just the banking industry itself. Again, it's about, I'd say one quarter, if that, maybe 20%, maybe 15% are up, the rest are down. Okay, so certainly the fact that rates are going down and it's affecting the economy, maybe the economy slowing down, people are afraid of credit risk building rising like it is with credit cards and auto loans. So that might be affecting the industry. Okay, so let's now turn to what's going on with on the regulatory side. And so a few things are happening here that are interesting is that one, the Federal Reserve is backing and proposing changes to the Basel III Accord for cushion, building that extra cushion for systemically important banks like the money center banks, and they're suggesting dropping the required capital ratio from 19% down to 9%. And I can't remember which ratio that is, but the point is that the money center banks have more sophisticated capital requirements than a community bank. And so it's all based on perceived risk. And so based on what they have and what they're doing in risky activities, then they're going to be required to have more cushion to absorb any potential losses. Okay, I'd like to note that the SEC is going to set up a joint venture with Commodities Future, well, the CFTC, and they're going to try to come up with a way to regulate the cryptocurrency market. So look for that to happen. Note that the Financial Stability Board is looking for ways to regulate. If it was going to be the SEC, it's going to be the Federal Reserve Bank, regulate non-bank financial firms because there is risk there and they're not regulated by the banking agency. So they're looking at ways there to recommend that they be regulated. So look for that to happen here in the coming year. Okay, so on the regulation side, the Basel III recommendation by reducing the required capital ratio from 19 down to 9% for the money center banks. The SEC is going to look at defining the fiduciary rule since a court stopped that from the Labor Department, stopped that requirement. And the fiduciary rule could affect banks that have investment banking practices. That's a possibility. And then again, look for the cryptocurrency market to be regulated here in the coming year. That's being looked at. So it's if you read the tea leaves and what's happening, that's where things are headed. So things like cryptocurrency exchanges like Coinbase, those companies might be affected. You looked at your cryptocurrency. You've got Bitcoin, which is probably the most recognizable name, but there are others. There's about a handful of them, from what I can recall. But definitely, Coinbase might be something that would be affected, or other crypto exchanges. So it's just something to be aware of. All right, so that is our weekend review for Sunday, September 22nd. Again, if you ever have any questions, please give me a call 916-952-2691 or send me an email at my email address. All that can be found at my website, cjlquantumanalytics.com. And we also have some premium products there, like an economic quarterly economic newsletter. So that's available. I think I'm charging $6.99 for that. I did post about 2 weeks ago a list of potential acquisition targets, community banks that are in the 100 million to $250 million market capitalization area. So these are they're smaller community banks, but yet we're talking 100 million to 250 million in capital, or market capitalization. When you look how big the market is for them, so I identified five. There's some surprises in there. Some are incredibly undervalued, and I make that apparent in my analysis, and it's all available. I think I'm charging 15.99 or something like that for that list of five potential acquisition targets. And again, this is designed for bank investors, for bank financial managers at a bank that's looking to grow, and also for mutual fund managers that are looking to invest in banks. All right, so I'm gonna sign off now, and it's been my pleasure to have this conversation with you, and I look forward to our conversation next week. Thank you.